Picture this. You did everything right. You worked, you saved, you avoided big splurges. Then you finally go house hunting and the math hits you like cold water. The monthly payment looks like a luxury car lease, the upfront cash looks like a small fortune, and the extras keep stacking up. In this video, we're going to count down the real reasons buying a house in America is starting to feel like a luxury product and what you can do to avoid the biggest traps. Number 12 on our countdown is the simplest, and it's the one people keep underestimating. Interest rates don't just nudge the price of a home. They can completely rewrite the monthly payment. In late February of 2026, a widely followed weekly mortgage rate survey put the average 30-year fixed mortgage rate at about 5.98%. That number might sound like a boring detail, but it is the difference between this is tight but doable and this is a no. Here's the part most people miss. When rates rise, your payment jumps even if the home price stays the same, and the jump is not gentle. On a 30-year loan, borrowing $300,000 at about 3% is roughly $1,265 a month for principal and interest. At about 6%, it's roughly $1,800 a month. At about 7%, it's close to $2,000 a month. That's before taxes, insurance, and all the other costs that sit on top of the mortgage. So when someone says, just wait for prices to drop, they're missing the point. Prices can drift down a little, but if the rate is high, the monthly payment can still be brutal. And most households don't buy homes with price. They buy homes with monthly. They buy with their cash flow. There's also a timing trap hiding inside rates. When rates fall a little, buyers rush in because the payment finally looks less scary. That extra demand can put a floor under prices. When rates rise, buyers pull back, but many sellers refuse to cut. So you can end up in a market where both sides freeze. That freeze is one reason the market has felt stuck for years. A national report on existing home sales showed that January of 2026 had a seasonally adjusted annual pace of about 3.91 million sales, with inventory around 1.22 million homes and about 3.7 months of supply. Those numbers are not just market talk. They describe a system where not many people are moving, and when people don't move, the few homes that do hit the market can stay expensive. Number 11 is that home prices rose faster than pay, and the gap didn't politely close. Federal income data put the median household income in 2024 at about $83,730. Now hold that next to the price of a typical home. A national real estate market report put the median existing home price in January of 2026 at about $396,800. That's the median, not the mansion. And in the full year of 2025, another national report put the median national home price around $414,400. When you combine prices like that with mortgage rates that are nowhere near the ultra-low levels of the early pandemic era, you get the modern affordability squeeze. One research group that tracks affordability using a share of income style measure pointed out that by July of 2025, the annual cost of owning a median-priced home was taking up about 47% of median household income. 47%. That's not a little stretch. That's a full lifestyle rewrite. This is where the luxury feeling comes from. It's not just the sticker price. It's the feeling that the basic, normal version of the product is sliding out of reach, and what's left is either a smaller product, a longer commute, a riskier loan, or a deal with more hidden strings. People talk like it's all about lattes and budgeting apps, but you can't budget your way out of a payment that eats nearly half your income without giving up something big. Number 10 is the lock-in effect, and it quietly starves the market of homes you can buy. Here's the situation. Millions of homeowners locked in mortgage rates that are far lower than today's rates. If they sell and buy another home, even a similar home, their payment might jump by hundreds or even thousands of dollars a month. So they don't sell? A major news report in late February of 2026 said nearly 69% of mortgage borrowers had rates at or below 5%. That means a huge share of owners are sitting on a golden ticket. They can move, but the math punishes them for it. The result is fewer listings, fewer choices, and a market that stays tight even when buyers feel broke. This also changes the starter home path. In a normal market, someone buys a smaller place, builds equity, then trades up. When listings are scarce and prices stay sticky, that ladder gets shaky. You might finally afford rung 1, but rung 2 is missing. That's one reason buying now feels like a luxury decision. You're not only paying for shelter, you're paying for access to a market that is not offering many clean upgrades later. Number 9 is the upfront cash wall, because the down payment is only the beginning. In 2024, a major survey of home buyers reported the median down payment was about 9% for first-time buyers and about 18% for all buyers. In the same set of findings, it reported that about 26% of buyers paid all cash. That last number matters because it explains why a normal buyer can feel powerless. When you're using a mortgage, your offer comes with inspections, appraisals, and lender rules. Cash can move faster and cleaner. Even if the cash buyer is not some giant company, the effect is the same. The market tilts toward people who already have assets. And the down payment is not the only upfront check. Closing costs can hit you like a second down payment. One nationwide look at closing costs reported that depending on the state, closing fees can run from under 1% of the home's sale price to close to 3%. Another dataset-based report described closing costs clustering roughly between about 0.5% and about 3%, with an average around 1.06% and a median around 0.88%. Even if you don't memorize those figures, the takeaway is simple. You can save for years for a down payment and still get blindsided by the rest. Appraisal, title work, lender fees, prepaid taxes, prepaid insurance, escrows, recording fees. It can feel like buying a ticket and then being told you still owe for the seat. Number 8 is that first-time buyers are being squeezed out of the market, and it changes everything about who gets to own. In a major national snapshot released in late 2025, first-time buyers made up about 21% of all home buyers, and the median age of a first-time buyer was about 40. That is not how the story is supposed to go. The classic idea is work in your 20s, buy in your late 20s or early 30s, start building stability. When first-time buying shrinks and the first-time buyer gets older, it usually means the entry point is harder to reach. It also means people who already own homes keep their advantage because they can use equity, not just savings. Now add a second layer that people don't like to talk about: family help. When prices and rates rise, a bigger share of first-time buyers need gifts, loans, or inherited money to clear the upfront wall. The result is not just some people buy later. The result is that the ability to buy becomes more tied to whether your family can help, which starts to feel less like a normal consumer choice and more like access to a private club. Number 7 is investors, and you don't need to imagine cartoon villains to see the effect. A housing data report covering 2025 said investors accounted for about 30% of single-family home purchases. That does not mean 30% of homes are owned by giant corporations. It means a large slice of purchases in that category went to buyers whose goal is an investment return, often through rent. When that share rises, the floor price for rentable homes can rise too, because the home is no longer competing only with other buyers who must live there. It's competing with buyers who can run a spreadsheet and accept a thin profit today if they expect rent growth later. Here's the controversial part that is still true. A home can be both shelter and an investment, but those two jobs fight each other. If housing is treated like a place to park money, prices tend to climb faster than wages. If housing is treated like basic shelter, the system tries to keep it buildable and available. In America, we often say we want both, but our rules and incentives usually lean toward the investment side. That makes owners cheer and buyers groan, and it makes the first home feel less like a starter step and more like a luxury purchase that needs a perfect storm of conditions. Number 6 is the quiet pileup of non-mortgage costs, because the monthly payment you see online is often not the monthly payment you will live with. Federal survey data showed that the median monthly owner costs for homeowners with a mortgage rose to about $2,035 in 2024, up from about $1,960 in 2023, adjusted for inflation. Notice what that means. Even for people who already own, the monthly burden has been rising. And that burden includes more than principal and interest. It includes taxes, insurance, utilities, and sometimes association fees. When those parts rise faster than wages, owning becomes more expensive even if your mortgage rate is low. This is why a lot of homeowners sound fine until you ask them about renewals. The insurance renewal came in higher. The property tax assessment jumped. The association fee rose. The roof needs work. And because these costs don't arrive as one clean number, people underestimate them. A higher mortgage payment feels obvious. A slow drip of higher insurance and taxes feels like background noise. Until it isn't. Number 5 is homeowners insurance, and it is turning into a second rent payment in some places. A consumer advocacy report released in early April of 2025 found that homeowners saw insurance premiums rise by an average of about 24% over the previous 3 years. It said the typical homeowner paid about $3,303 per year by 2024, and that the average increase over that period was about $648. It also reported premiums increased in about 95% of zip codes, and that in about 1/3 of zip codes, the increase was more than 30%. This matters for affordability because insurance is not optional if you have a mortgage. Your lender wants the home protected. So even if you find a home where the mortgage payment fits, the insurance renewal can wreck your budget later. And in some high-risk areas, it's not just price, it's availability. People can struggle to find coverage at all, or they end up with a policy that covers less than they assumed. That is a very luxury market pattern. You can buy the product, but maintaining the product becomes the real challenge. Number 4 is property taxes, because the bill can rise even when your income doesn't. A national analysis using federal survey data reported that across about 87 million owner-occupied homes, the average annual real estate taxes paid in 2024 were about $4,271. That's an average. In many places, it's far higher, and it can change quickly if home values rise or if local budgets shift. Property taxes are also one of those costs that feels invisible when you're house hunting, because listings don't always explain how reassessments work, what exemptions you qualify for, or how much the bill can change after a sale. Here's a simple way to think about it. A mortgage payment can be fixed if you have a fixed rate, but your total monthly cost is not fixed if taxes and insurance can move. That makes ownership riskier than people expect. In a world where buying already feels tight, unpredictable costs make it feel like a luxury gamble. Number 3 is the fee world that comes with modern ownership. Points, rate buydowns, and pay now to suffer less later. When mortgage rates are high, buyers and sellers start getting creative. You'll hear about paying points to lower the interest rate. You'll see temporary rate buydowns where the first year or two is cheaper, then the payment steps up. You'll see sellers offering credits to cover closing costs instead of cutting the sale price. None of these tools are automatically good or bad. The problem is that they are complicated, and complication favors the side that has more time, more experience, and more cash. This is where buying starts to resemble luxury shopping. In luxury markets, the sticker price is not the whole story. The deal is customized, the add-ons matter, the fine print matters. The person who understands the system wins. The person who is exhausted and rushing loses. And housing is the biggest purchase most people will ever make. So the cost of not understanding the system is huge. Number 2 is that supply is still the core issue, and we have not built our way out of the hole. One research estimate of the national housing shortage based on data through the third quarter of 2024 put the shortfall at about 3.7 million housing units. Meanwhile, another housing industry analysis reported total housing starts for 2025 around 1.36 million, with single-family starts around 943,000, down compared to the prior year. Those numbers don't have to be perfect to tell the story. When the country produces too little housing for too long, the scarce housing becomes expensive housing. And when the scarce housing becomes expensive, ownership starts to look like a luxury. There's a common belief that the market will fix it. But housing is not a normal market. Land is local. Zoning is local. Permits are local. Neighbors show up to meetings. Builders face financing costs, labor shortages, and material prices. Even when demand is obvious, supply doesn't snap into place quickly. It takes years. So when we underbuild and then try to catch up, the catch-up often arrives as higher-end housing first, because that's what pencils out financially. The entry-level home, the one that would help first-time buyers, is the hardest product to deliver at scale in many places. Now we reach number 1. The biggest reason buying a house is becoming a luxury. The system increasingly rewards whoever already has a house. It rewards them with built-up equity when prices rise. It rewards them with stability when their mortgage rate is low. It rewards them with leverage when they sell and roll that equity into a new home. And it rewards them with political power because homeowners vote, they show up, and they defend what they already own. That sounds harsh, but watch how the incentives line up. If you own, rising prices feel like success. If you don't own, rising prices feel like the door closing. If you own, you might oppose new development near you because you fear traffic, noise, or change, and because scarcity protects your value. If you don't own, you want more homes built because supply is your only real path to lower prices. This is not about good people and bad people. It's about incentives. And incentives shape rules. When rules limit supply, the existing product becomes more expensive. That's basic. You can see this owner's first system in the data patterns too. In 2025, existing home sales totaled about 4.06 million, matching the lowest level since the mid-1990s. Fewer moves means fewer chances for new buyers to get in. Another market research report found that in the first 9 months of 2025, only about 28 out of every 1,000 homes changed hands, the lowest turnover rate since at least the 1990s. Low turnover is not just a statistic. It's a signal that the market is not circulating. It's a sign that access is tightening. There's also a money side to this that people miss. A large research institute found that a typical home buyer in 2024 would need to spend about 45% more of their income on mortgage payments than in 2019. That's not a small change in 5 years. That's a shift in what a normal life can afford. When the cost of entry rises that fast, the people who already entered earlier gain an advantage that newcomers can't match. That's exactly how luxury markets form. The early buyers get in at yesterday's terms, and the later buyers face today's terms. So what does a normal person do with all of this, besides feel stressed? First, separate the fantasy payment from the real payment. When you run numbers, don't stop at principal and interest. Add taxes, insurance, and a realistic repair budget. Stress test it. Pretend taxes or insurance rise next year because they can. Use the recent reality, not the best-case daydream. We already know that in recent years insurance premiums have surged in many places, and property taxes are a meaningful recurring cost. Second, treat time like a weapon. If the market in your area is slow, don't rush just because you're tired. When sales volumes are low and listings sit longer, buyers sometimes gain room to negotiate, especially on repairs, credits, and closing costs. The goal is not to win a bidding war. The goal is to avoid becoming house poor and trapped. Third, be honest about trade-offs, because the trade-off is the whole game now. Square footage, location, condition, commute, and monthly payment are linked. If you demand the most desired neighborhood, a turnkey home, and a payment that fits easily, you might be asking for a product that barely exists for your budget. That's not a moral failure. It's the market. But once you admit that, you can choose the trade-off that hurts least. Fourth, watch out for the pretty payment trick. A temporary low payment can hide a later jump. A low down payment can hide higher monthly costs through mortgage insurance. A cheap-looking home can hide big repairs. A house can be affordable on paper and still destroy your savings if it needs major work in year one. The luxury version of buying is buying with a cushion. If you don't have the cushion, you have to be extra careful not to buy a surprise. Fifth, remember that renting is not automatically throwing money away. Renting is buying flexibility. It can be the smarter choice if ownership costs are unpredictable in your area, if you might move soon, or if buying would drain your emergency fund. A home can build wealth, but it can also concentrate risk in one property, in one neighborhood, under one set of local rules. And finally, don't let the conversation shame you. The market has changed. Incomes have not kept up with prices in many places. Mortgage rates reset the payment math. Inventory is limited because owners are locked into older low rates. The share of first-time buyers has fallen to unusually low levels. None of that is fixed by skipping coffee. Let's recap the biggest takeaways. Rates matter more than people think because they hit the monthly payment hard. and a widely watched survey had 30-year rates around the high 5% range in late February of 2026. Prices stayed high relative to income, with median household income around $83,730 in 2024, while typical home prices hovered in the high 300s to low 400s of thousands of dollars in recent national reports. Supply stayed tight because many owners are locked into low rates, and sales volumes have been near the lowest levels since the mid-1990s. The upfront cash wall is real. Closing costs are real, and non-mortgage costs like insurance and property taxes can rise fast enough to change your whole budget after you move in. And underneath it all, the system increasingly rewards people who already own, which is exactly how a normal product starts to look like a luxury. If you want, comment with this one question. In your area, what is the one cost that surprises buyers the most? The monthly payment, the insurance, the taxes, or the repairs? If this helped you see the market more clearly, like the video, share it with someone who's house hunting right now, and tell me what city you want me to break down next.